Hey everyone, in this video I'm going to highlight one growth stock that's down 71% off its high that I think makes an excellent buy right now. So this growth stock is Okta, the cybersecurity company, and the cybersecurity industry is expected to grow for at least another decade as more and more of our lives move online and digital. More and more necessity for protection is becoming required. And so Okta is benefiting from that trend as its revenue has grown over the years from a little less than 200 million in 2017 all the way up to 2 billion in the most recent trailing 12-month period. Now, I also wanted to discuss Okta's operating profitability, and before 2021, Okta was demonstrating solid growth in operating profit margins. However, that trend eliminated and reduced and then bounced back up in 2023. You see this V-shaped recovery here from Okta and their trailing 12-month operating profit margin. Now, one thing the company is doing is slowing down hiring as it has experienced a slowdown in its growth rate. Enterprises entering into 2023 slowed down spending wherever they could. So even if they wanted to add Okta's services, what they did was they delayed the start of the purchase. So they said, all right, you know what? We do want to purchase this. We see it as a necessity, but right now we're uncertain about what's going on in our business. So can we pause or delay this deal for another 6 months or another 3 months? And so that was happening worldwide with enterprises because worldwide and businesses feared that we were going to get into a recession because the Federal Reserve has raised interest rates so significantly in the previous 12 months. Now, businesses are not so afraid of a recession as they realize consumer spending has remained robust and the rising interest rates are affecting small pockets of the economy like new car purchases, like home purchases, and things like that. Not industry wide, not economy wide just yet. That's the key, just yet. There are still risks that a recession may be coming down the line when consumers run out of the excess savings that they had built up during the pandemic. So there's still difficulty in the macroeconomic environment. It's not back to those growth at all costs type of scenario we had, but it's getting better than it was in mid to late 2022. The other thing I wanted to look at and show you with Okta is its phenomenal growth in cash flow from operations. You can see here the company's grown its cash flow from operations from the negative territory all the way up to 268 million in its most recent trailing 12-month period. And what I also like to do with cash flow from operations is compare it with revenue to see what percentage of revenue is turning into cash flow. So let's go back to that slide on revenue, and you'll notice 2 billion in revenue and 268 million in cash flow from operations. So more than 10% of revenue is turning into cash flow from operations. A solid number to be sure for a company that's growing as quickly as Okta, and the rate of growth is phenomenal as well. After briefly dipping here in 2022, it's bounced back significantly all the way back up to 268 million, the highest in the company's short history. Finally, valuation. I chose to use the forward price to free cash flow, and judging by this metric, Okta's stock has never been cheaper. It's trading at a price to free cash flow of 54.17, and given this rate of growth in cash flow from operations, paying a price of 54 price to free cash flow is excellent in my opinion. So you're getting a company that's still growing rapidly and you're paying, yes, you're not paying a cheap price, but when you look at the price in relation to growth, then you're getting a good deal. You're getting an excellent deal when you're purchasing Okta stock. So for all those reasons, I think Okta is one growth stock you might regret not buying on this big dip.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.